So continuing in Chapter 6 of Price Analysis, a fundamental approach to the study of commodity prices. We just talked about what affects supply of a commodity, and so now we'll talk in general about what affects demand. And this will be very familiar straight out of Economics 101. Demand is affected by things like consumer income. When people have more money, then they spend it on more goods, including commodities that we talk about in this class, like corn, soybeans, wheat, livestock, and other stuff. One thing that's important to note is that this includes foreign income because we export a lot of our commodities, and you see faster income growth in developing countries, so it has a more sort of noticeable impact year to year than if we think about changes in consumer income in the United States. And particularly important for commodities is that rising incomes in developing economies usually goes hand in hand with rising consumption of meat. And when you're talking about corn, soybeans, and wheat, they're largely used to feed livestock animals. And so rising demand for meat is obviously important for livestock demand, but it is also a big factor for commodity demand as well. Similarly, you might not think about exchange rates being important, but exchange rates are definitely important in commodity prices. So we've mentioned this in class, but if the dollar is weak, then that means that consumers in other countries have more purchasing power, so they can afford to buy more dollars, which means they can afford to buy more goods denominated in dollars, like U.S. soybeans or U.S. corn, U.S. wheat, U.S. beef, U.S. dairy, etc. All right, so let's get into the concept of a balance sheet. And we're going to actually start with introducing the concept of a balance sheet by talking about the marketing year in particular. So if you hang around people who follow markets long enough, you'll hear them say the word marketing year over and over again, and I think I've said it many times in this class without actually defining it. So here's what it means. Since commodities are produced once a year and then consumed throughout the next year, we talk about that time frame as the marketing. So for example, and for corn, we typically start harvesting corn in September. Harvest really ramps up in October and November. And then we, in the Northern Hemisphere anyway, we don't have any more corn come on the market until the next September. So the marketing year for corn begins in September when we harvest those first bushels. And we just, no matter when the harvest actually starts, we just define the beginning of the marketing year for corn to be September. And then talk about that being a September to August calendar year. So for example, we've just entered a new marketing year for corn, September 2017. This marketing year will run all the way until August 2018, as we see how not only the supply that we're going to realize in the next couple of months, but the demand factors play out as people who are using corn, soybeans, and wheat start making orders for that product. We can keep track of that and see how much of the stuff we have left month by month. So that's a marketing year. Corn and soybeans marketing year starts in September, and the wheat ones are a little bit more confusing because you have to remember when different varieties of wheat were planted and when they were harvested. So remember, spring wheat or Chicago wheat, that's planted in the springtime, and it grows through the summer, and then beginning of the marketing year is August. So that means harvest of spring wheat usually happens in August. Winter wheat is a little bit different because, remember, winter wheat or Kansas City wheat is planted in the fall and lays dormant over the winter months, sprouts out of the ground in the springtime, and becomes mature in like around June or July. So beginning of the marketing year is defined to be July for winter wheat. And so that would be a July to June calendar year. Table 2 outlines the forecasting calendar for the 2017-2018 marketing. Now keep in mind that the 2017-2018 marketing year is the one that, as of today's recording, we're just entering. So this is September 2017, and harvest is just about to start with full force around Champaign County, Illinois. And so we're just entering this marketing year, 2017-2018. However, we began forecasting for this marketing year pretty much a year ago, just about now. So a full year in advance, we'll start forecasting supply and use for the coming marketing year. And obviously that's going to have to be based on things like trend forecast, recent history, and economic relationships. So we look back at trend yield, we look back at how many acres we planted last year, and we make some educated guess about what supply is going to look like for the next year. The same thing goes for the demand side. We think, okay, how much have we been using corn to feed livestock? How much have we been using corn to produce ethanol? And those recent numbers are going to impact our year in advance forecast for what the 2017-2018 marketing year is going to look like. Then the spring of 2017 rolls around. That was just about 6 months ago. And at that time, we would start updating our supply forecasts, especially as those USDA acreage surveys come out. So the prospective planting survey at the end of March and the planted acre survey at the end of June are incredibly important to the market. We pin down exactly what acreage is going to be. And at that point, we still don't know what yield is going to be. But as you move a row down in Table 2, in the summer of 2017, we start to update those yield expectations based on the weather that we observe. And for most of us, that comes to us through USDA crop and stocks reports. So then finally, we get to the beginning of the actual marketing year, fall 2017, and we start to get more certainty about what the supply is going to look like because we have a pretty good handle on what acreage is by the fall of 2017. And we're starting to get a more clear picture of what the yield will look like in the fall of 2017. And again, for most of us, that yield uncertainty is especially revealed as the USDA production reports come out every month. Now, as of the fall of 2017, we're just entering the marketing year, and there's still a whole year left because we have to observe how fast the commodity is consumed throughout the next year. So basically from the fall of 2017 to the summer of 2018, that's what that dash summer of 18 represents in the last line of the table. We'll be continuing to update the supply forecast because the USDA will revise that yield number all the way through until sometimes January of 2018 or the next year. And then also we observe like pace of consumption of the stuff throughout that time, and also we see Southern Hemisphere production come into the picture between the fall of 2017 and the summer of 2018. So that's kind of the outline of that. And then even the summer of 2018 will still be revising those use categories because it won't be until a little bit after that that we really have a certain picture about what use really looked like. Okay, that next section says Southern Hemisphere production. It's there because if you're trying to keep a balance sheet of like a global balance sheet for corn, soybeans, or wheat, it's increasingly important that you look around the world to make a real actual account of what the supply and demand picture looks like. I won't talk about it much here because we're adding another chapter on Southern Hemisphere production that will appear a few chapters down, so I'll just leave it at that and ask you to look ahead for that. Okay, so one caveat before we get to actually looking at what a balance sheet looks like, and that's the topic of uncertainty. So we're going to be approaching balance sheet analysis from the perspective of considering the USDA WASDE report balance sheets, and it's important to keep in mind that while these reports are an incredibly invaluable tool for commodity market analysts and traders and stakeholders and just about anyone involved in the commodity markets, they are definitely produced with a considerable amount of uncertainty. And so if you start following these markets, you'll notice that sometimes, and particularly in years where we're quite a bit above or below trend yield in particular, those estimates can change pretty dramatically from month to month. And it's not uncommon to see those estimates move around a bit because it's an incredibly difficult job keeping track of what goes into the balance sheet, and you just have to keep improving on the information month after month, and that means that those numbers are going to be a little bit variable, and that can be a little bit frustrating to market participants because when the USDA numbers are variable, then the market prices are variable. And when you're trying to make your living based on some expectation about market price, that's really frustrating. But it is what it is. It's a very difficult thing to predict. Okay, so let's move on. So table 3 here shows a very typical and generalized format for a balance sheet for any kind of crop commodities. So this would be the format, the basic format that we'll use for corn, soybeans, wheat, things like that. So it basically breaks down supply and demand, and for some reason we have a tradition of calling supply and demand stocks and use. So stocks is the supply, or how much of the stuff we have on hand or expect to have on hand, and use is demand, and that's how much of the stuff have we used up so far or that we will expect to use up through the course of the complete marketing year. Okay, so these rows right here make up the stocks rows, and you can think about that as supply, and then these down here are what we call use. So supply, let me highlight this here. Supply is made of 3 different components. One is this thing called beginning stocks. And beginning stocks is simply any of the commodity that we produced last year that we did not consume, and it's still in storage available to consume into the next marketing year. So these, and it's almost always the case that we carry some considerable amount of stocks from one crop year to the next. And that's actually a good thing because that ensures we don't have any stockouts. And that could cause, as we saw in our last homework assignment for Chapter 4, we saw when you get close to a stockout, then we get some pretty dramatic things happening on the forward curve as prices start to shoot up to ration consumption while we are approaching that stockout. So on a balance sheet, we're always going to say, how much do we have left over from last year? And we're going to put that in the line beginning stocks. Then the production line is going to be pretty simple. That's basically going to be our acreage estimate and our yield estimate. Multiply acres times yield, and you'll get total production in, say, bushels if we're talking about corn. And then we do import a modest amount of many of these commodities, even though we are major world producers of it. So we'll keep a line there to keep track of how much of the commodity is coming into the country. And that pretty much makes our total supply. So how much did we bring in from the last year? How much did we produce ourselves this year? And how much did we import from other countries? That's our total supply for one marketing year. Similarly, for the demand rows, we will say, okay, how much are we going to consume ourselves? And different commodities will have different components of this. For example, we produce a lot of ethanol from corn, and in the corn balance sheet, we give basically its own line to ethanol production and separate out that domestic consumption in a variety of ways depending on what we typically use that commodity for. And you'll see some specific examples of that in the chapter as we read down below. So how much do we use ourselves? The next row is how much do we send to other countries in export, and then residual, which we'll talk about that in the example below. But it's basically, okay, we know how much supply we have, we know how much we used in this country, we know how much we used as export, and then one of the rows we kind of just calculate as the difference between those. I'll give you a very specific example of that in a couple minutes. So we can sum these 3 rows together and we get total use. Now, a very important number that we get out of a balance sheet analysis is this thing called ending stocks. And we basically say to ourselves, okay, of the total that we produced this marketing year, we're going to subtract off the total amount we used or consumed, and that's going to be how much stocks we have left over from this marketing year. And think about it, in the next marketing year, that's the number we'll put here as beginning stocks. So what we have left over this marketing year will become the next marketing year's beginning stocks. And that tells us how much of a supply and demand balance we have. If ending stocks are very high, we know we have kind of a surplus, prices are probably pretty low, and likewise, if ending stocks are low, that means demand is strong and supply is relatively scarce. Prices are probably going to be pretty high in that kind of environment.